One misconception with the infinite banking concept is that base premium is bad. Well, stick around today because we're here to tell you that base premium ain't all that bad.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Thanks for joining us today. And today what we're going to be talking about is why base premium ain't all that bad. If you've listened or done some research in IBC space, you've come across some people out there just bad-mouthing base premium and that you've got to get it to the absolute lowest that you possibly can. There's a little bit of truth to that, but today what we're going to do is we're going to spend some time talking about why that is not always the case. Right, Anthony?
Yeah, I'm looking forward to it.
Yeah. Some people refer to the base premium as the cost of insurance or that it's an expense, and we would say that that's just a gross misstatement. Some advisors are out there kind of dismissing or dissing base premium. Anthony, why do you think that is?
What I think is
speechless.
Yeah, no.
Wow,
well, I want to be not. I don't want to say politically correct, but I want to be respectful, meaning that I don't like reaching of why somebody's doing something, you know, or if they have this ill intent, and I don't necessarily think that they do, but I think they're dissing the base premium. For one, I think they want to make themselves different than other people, and I think they're looking solely at the numbers, right? And there's much more that goes in, not just to the policy, but into life and infinite banking. It's a lot more than the numbers. But what I don't like of what they do is they say, like there's one guy I've heard him say, well, hey, I designed this with a low base because I don't need to make a lot of money. I've retired like 3 or 4 times. I'm just doing this to help people. But what he's saying is that if we have a higher base, that we're doing something that's unethical. And the same thing, and there's some companies that promote like I would call it a skinny policy, where maybe the base premium's 10% and the POAs and the term riders are 90. And they've constantly said, if you're not designing it this way, your agent is just making more money off of you. And that what I don't like is when somebody is they're bringing down others to lift themselves up. And I will say, as I kind of say that, I kind of think, am I doing that sometimes? You're like, I know we just did a series of why we don't like index universal life. Right. But I'm not bad mouthing any advisor. I'm bringing truth to the downside of this product. Right. But, now just a little plug. There's even a lot more content. We're doing a more series of these shorts or reels. So some of it is our podcast, but some of them are unique clips kind of talking about infinite banking and passive income. So if you're not already, check us out on either YouTube, Instagram, or TikTok.
Wow, very slick.
Right? Slick.
I saw what you did there. That's good.
Right?
Man, you're getting good at this podcasting thing, Anthony.
I'm getting there.
Man. Well, let's get back on track on that.
Well, I want to say one more thing, because sometimes as I say that, how many times am I bringing you down with your amazing hair, right, to compensate for me? So there is some place for me to work on. But again, relating to the podcast, I think it's good content. So
yeah, you're right. You do have a lot to work on.
And kind of what the point I'm making is that, you know, how much base to PUA you have is subjective. I don't think there's a one size fits all. It depends a lot on the situation and the goals they're trying to accomplish.
Great. And if you guys stuck around so far, right, today's conversation isn't going to be revolving around kind of base premium, 90-10 policies and those things. We actually did an entire podcast on that. We'll stick that in the show notes. But today, what we're going to be talking about specifically is kind of the benefits of the base premium, right? The pros, and then also some of the cons. And so that's what we're going to be discussing today, right, Anthony?
Yeah. And so we're going to talk about what they are. And then the pros and cons, the way we're going to break them down is just as you said, not a specific split, but just having more base or more PUAs.
Mhm.
Okay. Now, so first, let's talk about the what.
Great.
Right. So the base premium, this is a traditional whole life policy where we sometimes refer it to as your mama's whole life.
Mm-hmm.
Right. And what that does is it provides a large amount of death benefit. However, it takes a few years to build up cash value, but those premiums will create cash value. And that's one of the things that I don't like when people will call the base premium cost of insurance or an expense. It's just more of a delayed asset.
Yeah.
Okay. But if you have a whole life policy, you're going to need some level of base premium. You can add PUAs on there, and the amount that you can add is dependent on a couple things. For one, it is the MEC line, or what the IRS deems as what's taxed as life insurance and what is taxed as an investment. Now, we can raise that MEC line by adding some form of term insurance. However, term insurance is an expense, so we do need to be careful of how much expenses that we put on the policy. And another factor that leads to how much you can put into base and PUAs is the insurance companies.
Mm-hmm.
Some of them have limits on what that ratio is going to be. And also,
there's more.
Some companies, you can't really, it's difficult to design that a split specifically.
Mm-hmm.
They may have some other term riders that might make it a little bit different. So we can't even really allocate a percentage.
Anthony, great points on kind of what the base premium is. We've also kind of divvied up the way that each of us kind of approach the base premium. So we've got a list of our pros. Anthony, I'm going to have you go first. What are some pros to the base premium?
So you're having the pro go first for the pros? Okay, perfect.
I'm just going to come behind you and knock out the park.
There's actually a lot of pros of having more base than more, say, a skinny policy. I mean, for one, is that the higher the base provides a higher death benefit. And I guarantee you, death benefit will become important at some point. And if you don't believe me, ask your mom, or if you're lucky enough where you have a grandparent still alive, ask them if they wish they had more death benefit. I'm willing to bet a better question is, do they wish they had any death benefit? Right. Because most of the time we're in our 70s and 80s without a death benefit. And again, a lot of and I think we do this as well, where we don't focus on the importance of the death benefit. We're so focused on the cash and building that passive income. But I know quite a few clients that are going through a struggle right now where death benefit is important. And one example is somebody had already gotten a policy, had gotten one of those skinny policies, but however, they weren't getting the proper service, or they weren't answering the questions that they had. They had some important questions because the husband got diagnosed with a serious form of cancer.
Mm-hmm.
Priorities change, right? You're not so worried about the cash value. You're worried about the death benefit. So we started looking at, well, what we need to do is we don't need to increase the cash value. We need to increase the death benefit. And one way we can do that, well, is paid up additions, right? Which we did do a podcast, I believe, 2 weeks ago, that those paid up additions do provide some death benefit. So we're like, hey, instead of let's make sure that we're maxing out the PUAs every year. The problem is, on some of those skinny policies, there are some term riders on there that will keep the death benefit at a certain level, meaning as your whole life will naturally, death benefit will increase. So each year you need less and less term. But the problem is that even if you were to put in more PUAs, it was not affecting his death benefit at all. And now, and this just happened today as well, that I got notified that a client of ours' son just also got diagnosed with cancer.
Mm.
And early stages, I don't know enough, but of the prognosis. But man, I can't imagine what that family is going through. And fortunately, we did get a policy on the son, and hopefully, I mean, this I believe is a curable cancer. So hopefully, he can get through this. When he does, it's gonna be very difficult for him to get more death benefit. But fortunately, because we already got a policy in place, they are not going to be able to take that away. But if with that higher death benefit, what that also means, maybe you need less term insurance. So there could be a cost in saving that as well. Also, with that higher base premium, that equates to higher dividends. Now, I ran a quick little report, and after 10 years comparing an all base policy, then I think this might have been a 60-40 policy, maybe 40 base, 60 PUAs or somewhere around there. But the bottom line is at the year 10, the all base policy had 57% more in dividends than say a 60-40. Now, if we look at maybe more of a skinnier policy, the difference in dividends are going to be even more extreme. And right now, dividends are at a historically low.
Mm-hmm.
So when we're doing those comparisons, those dividends aren't going to be as large when we're looking at maybe a skinny policy. But let's fast forward a few years. As interest rates continue to rise, dividends will rise. And then you're going to be very thankful that you did have a healthy base premium. Also, having a higher base premium provides more stability. Right? Our base premium is like the foundation of the policy, which means those skinny policies, they're more apt when there's changes in dividends or changes in premiums that could alter the MEC line.
Mm.
And the higher the base we have, the less risk of this turning into turning into a MEC. Those were a couple of the pros that I had of a higher base premium. What'd you come up with, Cameron?
Yeah.
Or you just want to say, Anthony, you did such a great job. Let's just go on to the cons.
I fell asleep. So I was surprised that you said something. So you woke me up. So thank you for that. But
You're welcome.
The way that I start looking at kind of the base premium, again, is the PUAs, right? We did a podcast on this, but this is really what drives the cash value early on. And again, we don't give enough respect to that base premium. When I'm looking at that base premium, the base premium, in my opinion, addresses 4 perils of life. The 4 perils being death, disability, long-term care, and retirement. If you talk to somebody long enough and you ask them what their concerns are financially, either it's one of those, typically it's going to be all of those at some point in their life. Mm-hmm. And that's really what that base premium is there to address. So when you look at that base premium, right, we've already talked about that's really what goes in to support that strong death benefit and provides that insurance coverage. So number one, obviously, if we're addressing the death as one of the perils, is we have that death benefit there. So when somebody passes, everybody is aware of that. And that's usually about as far as it goes in our understanding of what's available to somebody. But man, if you've got a whole life contract, you need to read it because there are living benefits in there. And there's one benefit in there that's called the accelerated death benefit rider. Mm-hmm. And what that does is that actually gives somebody access to their death benefit prior to their passing. So typically, once somebody's diagnosed with a terminal illness, they can access up to 50% of the death benefit, the net death benefit at risk in any certain year. And what I mean by that is if you have $1 million of death benefit, you have $500,000 of cash value, right? The net difference between those is $500,000. So that means somebody could access up to $250,000 of their death benefit in advance of their passing to use as a lump sum with no need for reimbursement, right? That is just to address quality of life. Huge benefit to most people because we don't have those long-term care policies in place anymore. typically. So death, right, is being addressed by that base premium. The other one that comes to my mind is disability. We've done a podcast on some of the riders that are available for a whole life policy, but there's two of them that are typically on there. They fall into the same category, but they are waiver premium riders. They're usually enhanced and then just a regular old waiver of disability. But what they do is they actually cover premiums if you are diagnosed as disabled. So that disability does have different qualifying factors based upon the extent of what they're going to cover. But man, just having the option or the ability to add that rider onto a policy where if you become disabled, the insurance company does come in and pay those premiums for an extended period of time, depending on, again, how long you're disabled. So those are something that you need to read, need to make sure you understand whether you put it on the policy or not. You do want to read that paperwork prior, make sure you make an informed decision. Ask myself, ask Anthony before issuing a policy. We're happy to give you kind of our 2 cents. The other thing I'd say on disability is typically those only pay out up to age 65 and then they shut off. So there's some things that you do want to make sure you understand in there. The third peril of life that I'm going to address with you guys is going to be long-term care, right? I touched on this is the long-term care market has completely dried up over the last 20 years. There's very few standalone long-term care policies that are out there anymore. And if somebody has one, they absolutely hate it, right? The cost of insurance has gone up, the premiums have gone up, and then also their benefits have decreased, right? So it was very difficult when long-term care policies went out into the market. They just didn't price it right. So there's not very many of them out there. But if you read your whole life contract, there is a living benefit on there that's called a long-term care rider, not a long-term care rider, but it's a very similar. It's called a chronic illness rider. And again, what that does is that gives you access up to 25% of your death benefit, your net death benefit at risk, or up to $240,000. So same thing, if someone's diagnosed with a chronic illness, that means something that's going to take place for 90 days or longer, then you can submit an application to the insurance company and you can access up to 25% or $240,000 of the death benefit. Awesome, right? So you can do that as far as a lump sum, or you can get monthly or annual distributions that come along with that. So again, that's one of the riders that not a lot of people are aware of. And I don't know when they did this, Anthony, you might, but I remember when we first started, these living benefits, I don't think they were required on the policies.
No, they didn't come in till a few years later.
Yeah.
So it's fairly recent.
Yeah, it's like 10 years ago, I think, is when they started kind of mandatory putting these on there. And so you started reading these. So not a lot of people, if you've had a policy for a while, you may not have it. If you want to pull an old policy out, look at it, or if you want us to take a look at it, feel free, reach out, send it in to us. We'll read it, make sure you understand what you've got. All right. So that was kind of the third peril. The last peril that I would say that the base premium addresses is going to be retirement. Anthony touched on this, but that base premium is really, really important. It's really just those first couple of years where it doesn't show up as cash value, but it's increasing that death benefit. After that third or fourth year, man, a majority of everything that you're putting in that base premium is showing up as cash, right? That's forced savings. You can leave it there and just let it accrue over time. That's like the worst thing that you could do with it. Or you can take those dollars, leverage it, and go buy some assets with it, which is only going to increase kind of your net worth, your cash flow, and everything else. So that, in addition, is also preparing you for retirement. But that base premium, again, is going in there. It's increasing your death benefit, which increases your dividends, which increases your cash value. The other point I would make on retirement is having that death benefit in place. I think we did a podcast on this, but it's kind of somebody's permission to spend.
I don't know if we did. Maybe we should.
If not, man, we need to, right? Because we talk about this a lot. And Anthony, you touched on it, is when you're meeting with somebody, is our intention typically when we start working with somebody is always focused on cash value. But as somebody starts to approach retirement age and we start looking at distributions and stuff, is, man, having that death benefit there allows somebody to spend down their other assets, right? Whether it's a taxable account, tax deferred account, something like that. And we can actually accelerate that spending down on those types of accounts because we have that death benefit there. We're not worried about running out of money. So that death benefit is valuable, and it becomes more valuable as you start to look at it and the way this whole thing works. So hope that worked for you guys. Hope that gave you a little insight. But man, 4 perils of life. that base premium addresses them all.
Oh, sorry, Cameron. I was asleep during
Yeah,
that.
exactly.
No, great job, and I like how you added the ability to access the death benefit while you are still living. I think oftentimes we're so focused on the cash, we don't spend time on the other advantages of having whole life. One comment I wanted to make on a lot of the riders you had mentioned, all of them come with it with no additional charge.
Yeah.
But the waiver of premium, there is a charge to it. So that one needs to be evaluated on whether the cost is going to be sufficient or not. Perfect. Well done, Cam.
Thanks. So that's some pros,
Mm-hmm.
right? We both kind of had our 2 cents on how we approach the base premium. Anthony, what are some cons? What are the downsides to the base premium?
I tell you, when we were coming up with these, I thought there was going to be a lot more.
Mm-hmm.
But
I agree.
Right, but we only came up with a couple, and the first one was that you're going to have a higher kind of increase, what we call have to premium. Kind of, when we have a premium with base and PUAs, that PUAs oftentimes we call that the want to premium, because you don't have to pay it. Only if you want to do you have to pay it. Now the base premium, that has to be paid to keep that policy in force, which why we call it the have to, because odds are in your life you're going to have some lean times, and we need to build in the flexibility of your policy. So the higher the base premium means when life happens, we can only lower it down to a lower amount. What was one of your cons, Cam?
Yeah, I could only think of two. That increased have to was one of them. And then the other one is the slow start, right? Is it does build cash value, but there is a slow start to it. And to be honest, that's probably one of, I think, the biggest hesitations that a lot of people have when they're looking at kind of starting infinite banking, starting a brand new policy, is that base premium, is because we're so focused on that cash value piece. And we say, hey, listen, you're putting this portion in there. It doesn't provide immediate cash value. And sometimes they kind of look at it like, all right. So when you step back, you look at the whole thing in its entirety, and, it ends up making sense. But I would say that those two things for me are the two things that I could think of: the increased have to, and that it does build cash value a little bit slower. But outside of that, there really wasn't much.
Yeah. I think those cons are large. I mean, they are heavy, right? But I think at the bottom line, that's where we say that this is subjective, really depending on your situation. For example, if the younger you are, I like a higher base premium, right? But as we get a little older, I think it may make more sense to have more going to PUAs. And one thing I didn't mention, and oftentimes, because this isn't how we design these policies specifically the individual, what happens oftentimes is those PUA, because of the MEC line, we may need to drop those PUAs maybe after year 10, 20, or so forth. But because of the MEC line, we might not be able to keep them on forever. But what that means is that the PUAs drop off, but the base stays the same. So we're going to be looking for places to store money, and we're having a larger base premium will allow us to store more money in the policy in the long run.
Well said. Guys, hope this was informative to you, gave you a little bit more perspective and appreciation for that base premium, because it really is important and does provide a tremendous asset in the form of that death benefit and then building those dividends. So hopefully gave you guys a little bit of insight as to why base premium ain't that bad.
And if you want to find out for yourself, maybe you got some questions or want to see if infinite banking is for you, get on the discovery call with us and one of our coaches. We'll gladly go over your goals and answer your questions and see if infinite banking is right for you. Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.